it's a horse race between OpenAI and Anthropic, and Anthropic is racing way ahead.
It'll be interesting to see all three of these companies, SpaceX, OpenAI, and Anthropic, all public. I would guess the combined market cap of those three companies will be not less than $6 trillion and possibly 7 or more.
That gets my vote for like merger of the year, maybe merger of the decade.
Do you have concerns about where Canva is going in the future? And do you think they still have a chance at an IPO? All right, welcome back to another episode of Trading Places, the world's worst VC secondary podcast. Aman, you've got a book launch that happened in New York this week.
Yeah, I was in New York doing a book event, the launch event. This is the A Brief History of Financial Bubbles. It's available on Amazon now. You can also get it at our URL at bigbubbletrouble.com. I thought it went great. We had a great launch event in Midtown. The New York Alternative Investments Roundtable kicked it off. About 150 people showed up, and we talked a little bit about, among other things, are we in a bubble right now?
Are we in a bubble right now, Aman?
Well, you'd have to read the book. But I'll give you the short answer is I don't think it looks anything like the 1997 to 2000 tech bubble. It doesn't really look like the 1845 to 1849 UK railway bubble. Just I think the valuations are better. We have real businesses, real cash flows. I'm pretty bullish on AI and what it's doing. So it doesn't mean that there won't be winners and losers, but I think we're in a much more constructive, much more reasonable environment than those really big, nasty bubbles.
Well, we're certainly in a bubble of news stories this week. We've got a ton of news going on. We're going to run down our headlines. So Anthropic is on the road for their roadshow. Sounds like there's going to be an IPO pretty soon, Aman, maybe even, I guess, September, October timeframe. But sounds like they're floating a $2 trillion number. Nvidia made a big announcement about a $500 billion AI financing initiative, along with 6 financial partners. OpenAI did an internal tender offer at $852 billion valuation. That's the same valuation they raised at. Cursor acquisition closed last week. We were talking about that, but that actually did happen on Friday. $60 billion in SpaceX stock. Canva has reported that their growth is slowing and projected only 20 to 25% growth rates going forward. And then we've got a string of acquisitions that are being announced. Anthropic rumored to be acquiring Descartes for $6 billion. Stripe talking about acquiring OpenRouter for $7 billion. And Silver Lake talking about taking Workday private at a $45 to $50 billion valuation. Databricks is still remaining private. We kind of expect them to go public sometime in the future, but right now they just raised another $5 billion at a $190 billion valuation. And then 2 companies are raising at $40 billion valuations, both Kalshi and Cognition. Let's go ahead and get jumping into our big story of the week, which is Anthropic reporting revenue at over $11.5 billion in the second quarter. But also, more importantly, on the road for their roadshow. Seems to be this company is going to go public in the next couple of months, Aman.
If they are targeting October, November, they want to beat that Thanksgiving deadline. That makes sense. I think the numbers. So you suggested the numbers hooked to a $2 trillion IPO number. They are hooking to probably 100 billion or 110 to 120 by the end of the year on ARR. I'm seeing some leaked numbers that are suggesting their internal forecasts are as high as $280 to $300 billion by 2028. This is the game that Elon started playing, and that's supposed to leak, 3-year forecasts on a roadshow. I guess it worked okay for SpaceX, and I expect that, for these premier companies, that's part of the gig. I don't know. Are you a buyer at $2 trillion? What do you think?
I think $2 trillion is actually cheap for this company. I think we're going to be seeing 100 billion plus revenue run rates by the end of the year. And I wouldn't be surprised for them to IPO at least at $2 trillion and possibly even see it go to 2.5 to 3 trillion after the market starts trading. I think we're already seeing the secondary market price Anthropic at $1.5 trillion right now, and there are no sellers. And I just don't see that going anywhere but higher, given what we're hearing about Anthropic's growth rates.
Yeah, there are different schools of thought on how to price the IPO. The aggressive way to do it, which was the SpaceX mode, was push to get every penny you can, and then you're taking your chances on volatility and what the next 6 months look like. And I think SpaceX is round tripped up and down and back again. Anthropic, if they were to price at 2, I think going too high is dangerous because then you create volatility. It's just discouraging for employees to be underwater. I would advise them, go closer to 2, get the deal done. If you leave a bit of money on the table, you can always do a follow-on financing later. I'm thinking you're right. 2 trillion is probably the conservative side. I thought they were worth 3. That's what I said a couple months
Yeah.
ago, and I'm sticking to it. So that doesn't mean there'll be 3 trillion day one, but I think over time it'll grow into that. And if they can beat the Thanksgiving window, I think that would be really good for them.
Talk of IPOs, we have some stories about Nvidia announcing a partnership with 6 different financial companies, lining up $500 billion in financing, really trying to turn chips into an investable asset. Nvidia signed memos with Apollo, Blackstone, BlackRock, Brookfield, Goldman Sachs, and KKR. Those are pretty big names in the industry. I'm kind of reminded, because I always forget who's Blackstone and BlackRock. This image is great for just remembering who is who. This is all the versions and combinations of Black Rock, Water, and Stone, and Bridge Rock, Water, and Stone. You'll notice that BlackRock and Blackstone are both investment firms, but Bridge Rock and Bridgewater are also investment firms.
Wow.
However, Blackwater is a mercenary army,
Yes. We'll do that.
and Bridgestone is tires. So 4 out of those 6 combinations are investment firms.
If someone says to you, Blackwater led my last financing round, they're either confused or they're not the kind of people you want to be dealing with. The origin story of Blackstone and BlackRock, they actually share a common founder and a heritage. I think they were founded in Steve Schwarzman and Pete Peterson and Larry Fink founded Blackstone, and then Fink left because he was disagreeing with them and went with BlackRock. And now they're the largest asset manager in the world, and Blackstone is the largest private markets like real estate, private equity, and alt asset manager in the world. So that is some big time Wall Street money behind this Nvidia deal.
I was going to say, like, this really, I think will have a positive impact for a lot of other companies, not just Nvidia. Probably will help with anybody who's trying to finance purchases of, chips for future expansion. I think there's been a lot of concern about, companies that are not financeable entities borrowing tons of money to build out their chips. We had that big deal with OpenAI and I guess a number of people, but OpenAI with SoftBank, also OpenAI with Oracle. Just feels like this is going to, I guess, provide a lot more confidence in the market for people who are borrowing money to finance expansion in AI.
Yeah, it makes sense. When those deals were being announced before, we talked about them as circular financing deals, and the concern there is that you're betting money from a provider like Nvidia who gives money to their customers, and then the customers use that money to pay them back. That alone isn't the end of the world. Like, think of it when you buy a car, you might go to General Motors and buy a Corvette or something for $100,000, but nobody can pay $100,000 for a Corvette. So you'll put $10,000 down. You'll put 90 on credit. You can borrow the 90 from a bank, or you can borrow the 90 from General Motors Finance or GMAC. They're not a traditional bank, so they have to find the money elsewhere, and they'll float bonds and do asset-backed securities. And it all kind of works as long as it's commercial terms and as long as there's some independence on the valuation. And then the asset has to be good and the credit has to be good. And the fact that I think Nvidia is now working with these 6 independent investors who will be underwriting these deals, I think on a deal-by-deal basis, I think that makes it feel a lot better. It is a huge asset class. We're running at almost $1 trillion now a year in capex for these data centers. So this could be a $3-4 trillion asset class. Like the entire student loan market in the U.S. is $2 trillion. The car loan market is, I think, $2 trillion. So if you have a $3 trillion asset class out there, and the assets are real, and the GPUs are good for 4, 5, 6, 7, 9 years, the demand is real, the companies are making money, the credit risk is high. It does kind of make sense that this is going to become a real asset class that people will want to get into, right?
I think it's just a lot of confidence for the market and for everybody else to be providing deals. I think when Nvidia is basically providing a floor for the valuations and financing, I guess a lot of this comes down to how long do you amortize the asset over, and how long are these chips usable? And previously, maybe people were thinking these were shorter timeframes that were just 3 or 4 years. Now it sounds like we're really talking about 5 to 7, maybe even 8-year timeframes.
Yeah, I think we had locked into 3 to 4 year depreciation schedules for. That's what Nvidia used to do like 10 years ago, but they weren't building GPUs. There was, the chip manufacturers, Intel and folks like that typically do a 4-year depreciation schedule, but the GPUs are a different category. I think they are, they will last longer. They're also modular. They can be replaced. Think of like a smartphone, I guess. A smartphone, if you buy a smartphone, it might depreciate over 2 to 3 years in terms of its useful life because it just obsoletes and you buy a new one. But a smartphone can be good for 5, 6, 7 years. I think similarly, a GPU, it won't be used for the best in class models for 7 to 9 years, but it'll be used for other models. It won't be completely useless. It won't go to zero. So there is some value to it. I guess like a car, depreciating. Cars don't depreciate to zero after 3, 4 years. You can still drive it. I mean, I'm driving a 20-year-old car right now. It's not worth what I paid for it day one, but it's you take good care of it and it continues to have value. So I think Jensen sees that and he understands these GPUs and he's convinced these other banks that these GPUs really do have useful lives. That's the accounting term of probably closer to 8, 9, 10 years, not just the 2 or 3 that you depreciate over for accounting reasons.
Well, it certainly is a ton of financing to be made available, and I guess we'll see how that plays out over the next couple of months and years. Our next story is about OpenAI, and they just ran an internal $7 billion tender offer, valuing the company at $852 billion. That's the same valuation that they recently raised at. Interestingly, this was not a secondary sale to an external buyer. OpenAI financed this internally. I'm guessing that might be because they're in registration and they don't want to be changing the valuation for the company that they're going out with or have someone potentially value it lower. What do you think's going on there, Aman?
It's a horse race between OpenAI and Anthropic, and Anthropic is racing way ahead, and it feels like they're Secretariat, and they are at the 1973 Belmont Stakes. And they are way ahead, and OpenAI is like twice a prince, who finished second by like 31 lengths. And they are racing like at a speed that very few people can go, but Anthropic is just shot ahead at like a Secretariat level performance. So as Anthropic is going for the public markets, but just it's their time to go, I think OpenAI is like, well, we can't go at the same time. We have to let this other offering play out. The fact they didn't raise the money externally is interesting. And I think I would guess it's because they either couldn't raise the financing externally at the valuation they wanted. They wanted it at 852 billion, right? So didn't want to do a down round. In the next 6 months, if they continue to hit their numbers in 27, early to mid 27, maybe they're on an IPO timeframe, and probably not the greatest signal that they had to self-fund this and couldn't get someone else to do the interim financing. But I think the recent models are going great. I think they're probably at 40 to 50 billion in ARR right now. So maybe.
Yeah, I think that was the number that's been reported recently, that they're over 40 billion ARR, and still seems like revenue is doubling year to year. That's not quite as fast as Anthropic, but still that's a pretty healthy growth rate. I'm not sure I'm as concerned about OpenAI as I might have been like 2 or 3 months ago. There was certainly a lot of, negative announcements, a lot of headwinds, but it feels like OpenAI is steadying the ship. And my guess is, they will IPO sometime probably in Q1 of next year. I wouldn't be surprised for them to float at least $1 trillion number for the IPO and possibly even higher by that time. I'm not too worried. I think maybe in comparison, Anthropic, their
Yeah.
star might have dulled a little bit, but in comparison to any other company, it's a pretty
Yes.
stellar story, right?
Yes, that's the motto for Twice a Prince. It was a great horse in 1973, but had the misfortune to run against Secretariat 3 times in a row. So you think OpenAI could be a $1 trillion company? You think Anthropic could be a $2 trillion company, $3 trillion company?
Oh, I think I think Anthropic is at least a $2 trillion company and possibly a $3 trillion company, given the growth rates. It depends on what time frame we're talking about here, but by the end of the year, yeah, I'm pretty sure it could be a $3 trillion company. It'll be interesting to see all three of these companies, SpaceX, OpenAI, and Anthropic, all public, probably sometime, I would guess, by the end of Q1. And I would guess the combined market cap of those three companies will be not less than $6 trillion and possibly 7 or more.
How long did it take you to grow that mustache?
Couple of days.
I wish I could grow one.
Our next story is about the Cursor acquisition. We had talked about this last week. This officially closed on Friday for $60 billion in SpaceX shares. Pretty amazing story that this company really didn't exist much more than like 4 or 5 years ago. One of the best investment returns ever. I guess some of the investors were the accelerator Neo, which is run by Ali Partovi. I believe they invested less than $2 million and probably going to return more than $1 billion on that $2 million investment, or something less than a $2 million investment.
Holy smoke.
Andreessen, also a big investor in the company as well. Pretty good marriage, don't you think, between SpaceX and Cursor?
Yeah, and it's in stock, I guess, right? They're going to take SpaceX stock, and it's public, so that's liquid. Yeah, that's a great deal. I mean, they are. It does seem like that team is just. They've been with Elon now for a few months, and it seems like, from everything I'm hearing, that team is performing really well. Keeping up with Elon is fantastic. It looks like they will be at a. If they're at a $10 billion revenue run rate at the end of the year, and Elon is guiding to $100 billion in ARR by the end of the year, I mean, that seems like for $60 billion, if you can acquire a company for stock, pay $60 billion, have it be at a $10 billion run rate, and a key part of your AI business, that gets my vote for like merger of the year, maybe merger of the decade.
Well, I think it was recently announced that Cursor is doing $4 billion in revenue. That's up from $3 billion just a few months ago. And like you said, I think there's projections that they could get to $10 billion by the end of the year. So that's a pretty amazing growth rate. I guess acquiring the company at, $4 billion is only a 15x multiple, which is pretty reasonable. But if it gets to $10 billion by the end of the year, then I think you're really reasonable on some of those numbers. Probably more important than just that valuation, though, is the way that SpaceX is using Cursor to build their own internal models for AI. All right, a not quite so lovely story. Canva recently announced their Q2 numbers were not so shiny and amazing. They had cut their growth rates, I guess, from between 35 to 45% down to only 20 to 25%. After Canva announced that their growth rates had slowed down, some of Canva's investors, Blackbird and Airtree, cut their valuations from 42 billion to 35 billion. And Canva's own internal valuation was cut to 31 billion. I believe that was because they're valuing common shares, not preferred. That's about a 20% cut in valuation. I guess there might be some concerns that it could go even lower than that. We should disclose that we're indirect investors in Canva through secondary purchases. Do you have concerns about where Canva is going in the future? And do you think they still have a chance at an IPO?
Let's start with the facts as we know them, and then we can think about the concerns on the IPO front. So Melanie Perkins is the CEO, and she said they disclosed financials for last year. It's interesting; they're private; they don't have to do this, but they are, and that's because I guess they've been doing tender offers with employees and taking on new capital, and they are looking at the IPO. So I give them credit actually for being transparent with investors and behaving as you would expect a public company to do. So they have done their own internal valuation and disclosed financials, and they said they were at $3 billion in revenue. That's GAAP revenue. They're Australian, but they're using US dollar GAAP numbers. They were at $3 billion in GAAP revenue last year. ARR probably in the mid threes. They were growing at 30% at the start of the year. You said now they're saying it'll be 20% or so by the end of the year. The reason why and they're profitable and have been for
second quarter revenue was 922 million. That was up 25%. So that was the growth from the quarter. However, projected growth only at 20% going forward.
And the reason why they have said that is they are adding customers and continue to add subscribers, but they are seeing the cost of tokens go up. Their AI servicing costs are up pretty dramatically, and they're moving through in-house models as opposed to going out to buy these expensive tokens. So that's pressuring gross margins, and that's slowing them down. So I think that is a concern. The question really is, are you at 30% revenue growth on the way to 20% and then lower? Or as you move to these AI internal models, are you able to reaccelerate revenue or at least slow the growth in the decay with AI features? The concern, I guess, on the IPO show right now, roadshow now, would be, hey, look, every chat GPT release, you can do more. And the more and more in the core AI product, and Canva and HubSpot and Wix, like all these companies, are Figma, they're all being existentially challenged. Figma, by the way, is 8 to 10 times sales, and they reported last week as well, and they're showing pretty strong revenue growth, but also compressing gross margins the way that Melanie talked about it. So I think the concern is you really have to grow and put up a couple of quarters where the growth rate is 20% or more. I think if you can do that, they will probably be okay. So if you look at the types of companies that the market is segmenting on the left, the existential risk, the slowing growth, 20% going down to 15, down to 10, profitable, but where the founder seems to exhibit some fatigue or existential dread, you don't really want to be in that category. That's that's like Asana and Box and Monday. Airtable just got taken out by Bending Spoons at about a 3 times sales multiple. So you kind of want to avoid that category because that wouldn't be a valuation that Canva would want to get. On the far right, you've got a bunch of companies growing at 20, 25% year over year, and they do have multiples of 15, 17, 20 times. There are some very fast growers like Palantir and Databricks. But Snowflake or Datadog are growing in the mid-20s, high 20s, and they're more AI adjacent, and they're profitable, but they're able to use AI as a story to talk about how they can grow and take share and how they can benefit from the AI wave. And then you get the ones in the middle, where I think you can get an IPO done, but it won't be a great multiple. It may be a 5 to 8x multiple. Figma's a bit north of that. HubSpot is another company that's facing this existential question: are they going to be around, or is AI going to replace what they do? And so I think Canva wants to avoid that middle box and move to that right box. And I think to do that, they just have to be able to show a couple of quarters of stronger growth and be able to put aside those fears that the features that they offer to consumers are going to get done by the next release of ChatGPT.
Our next news story is a rumor that Stripe is acquiring AI firm OpenRouter for $7 billion. This company provides a way for AI developers to switch between hundreds of AI models and managing costs. So very efficient for helping developers route and manage costs as they're building AI-based solutions. It's a pretty big number after OpenRouter just raised money at a $1.3 billion valuation. So very substantial increase in the value of the company in a pretty short period of time.
I kind of like this deal. It's a bit of a weird thing for Stripe to do. Stripe seems to be wanting to acquire everybody. They want PayPal. They want these guys. I think Stripe should just go public already and have a public currency stock. I think the reason to do, I was trying to think, like, why would you do this if you're Stripe? Where do you see? There's a lot of data because as I said, OpenRouter is matching developers to the lowest cost model, the most efficient model. I guess there's sort of a matchmaker, I don't know, a Tinder for developers, an Expedia where you just find the lowest cost, hotel or rental agency, but with an LLM model. So there's a lot of data. I think that's interesting, but why would Stripe be into that? And then I thought, well, if Stripe sees this as a currency, if they're viewing AI tokens as the new currency of the AI economy, then it makes sense. In the traditional web, developers would pay Stripe with fiat currency for like a subscription or a per seat license. In the new AI economy, that may not happen. It all may be just software consumption is around usage-based token economics. OpenRouter is like they're right in between the developers and the model providers, and so they're handling that currency. And Stripe doesn't want to let anyone get in the way of that transaction. Their moat is really just the total dominance of the developer mindshare. If you think AI tokens are the new currency of the web, then I think it makes sense for Stripe to do that and to maintain their hold on the developer community.
Right. Another acquisition that's being discussed right now, Silver Lake is thinking of taking Workday private. Workday is a public company that was previously valued in the $40 billion valuation range, but as a result of this news is now being valued in the $50 billion range.
That could be a major story, Dave. This could be the biggest software take private or buyout of all time. Workday, you remember, it sort of transitioned from this high-flying growth stock into a just more mature, cash-generating, SaaS company. The multiple on revenues was 3.5 to 4.5x sales up until last week. The growth rates are at 12 to 13%, so it's nothing to write home about. And they're a seat-based model, so it looks and feels like that pre-AI old school SaaS company. They were in danger of being what's the term? Bending spooned? Is that a term? Fodder for the Italians. We got to come up with something to brand that. But basically, they were headed into that category, I think, where it felt like they were going to get airtabled. But I think the fact that Silver Lake obviously thinks that has been oversold and that maybe there's a possibility, although they're not growing at 20% plus, there's still opportunity to grow it and to cash flow it and maybe to restructure the company the way that these guys do. So, and by the way, the SaaS index, the PBC SaaS index has bounced 71% off the April bottom. So I think there are a lot of companies in this category that were headed towards 2 to 3x sales that are now at 3 to 5x. And the fact that there's a bid coming in from private equity at closer to 5x sales with a buyout LBO catalyst. And bending spoons is another, possibility. It's just interesting that there are other ways now for these companies to find maybe a more reasonable exit.
Well, Aman, Databricks continues to grow at a crazy pace. Databricks just wrapped up a $5 billion funding round at a $190 billion valuation. I think they're now probably the number 3 or 4 most valuable private company. Is that correct on our list now that SpaceX is out of the picture?
Let's see. Would Anthropic and OpenAI are probably top 2. ByteDance might be 3. These guys might be 4. Yeah, they're in the
right.
They're certainly in that top tier. 190 is a great number.
Databricks has been growing pretty crazy. I guess 70, 80% growth rates. They recently topped $7 billion in revenue, still growing at a crazy pace for a company that large.
I mean, they could have gone public. I guess they decided not to, which is just interesting. Their CEO Ali Ghodsi, he's explicitly said 2026 is a terrible year to go public because you have to compete with SpaceX and Anthropic taking all the capital out. I guess like OpenAI, they're kind of biding their time and waiting for next year. And they got, unlike OpenAI, they got new investors in. They Coatue is the lead investor, but they have TPG and they've got Blackstone, I think, not BlackRock. Blackstone, I'll have to consult your chart, but Blackstone, I think, is in the round, and Bond Capital and Dragoneer and Fidelity and Thrive. So it's a great outcome. I think they are avoiding the public market log jam this year. They're probably my top IPO pick for 2027 right now.
Yeah, it would certainly suggest that both Databricks and Stripe are likely candidates for 2027 IPOs, at least if they want to.
But why risk it? If you can raise at $190 billion valuation from these top tier investors.
Well, our last news stories are going to be two companies raising at $40 billion valuations. Prediction market Kalshi is now supposedly raising at $40 billion and also doing $4 billion in revenue. Cognition is a company that's also raising at $40 billion valuation. Cognition is right now the most notable independent AI coding platform. That comes only 3 months after Cognition closed a $1 billion round at a $26 billion valuation.
Are we having deja vu? Didn't they just raise at a 26? I guess they're still in discussions, but they're over $1 billion in ARR. Their step up reflects the growth in the company.
On the Kalshi deal, what do you think is happening there? It seems like Kalshi has been pulling away from Polymarket in terms of both growth and valuation.
I can't tell. They both went. Kalshi was earlier into the U.S. market than Polymarket was. Polymarket came second. Kalshi was a little bit ahead in terms of getting their CFTC approval and federal regulatory approval, and then they cracked the sports betting market. And they are, you said, at $4 billion in revenue, so I'm guessing half of that or more is sports betting. And it's just been a great summer for that. I would not be surprised if Polymarket was like 3 to 6 months behind, though. I think both are on a similar trajectory. Kalshi might be just 6 months ahead of the game, and still I think have some regulatory concerns just because each of the states are still reviewing sports betting and what kind of disclosures and what kind of legality that is. But I wouldn't be surprised if Polymarket is is the next time we hear from Polymarket, they'll be close to that valuation within the next 6 months or so.
I think Polymarket's only doing about $1 billion in revenue at the moment, so growing fast, but not quite as fast as Kalshi is.
That's the last we heard of them, though. Wait until they may disclose a big surprising number in Q3, Q4. They're probably being selective in terms of what they tell us. I think Kalshi's being a little bit more, because they're fundraising right now, they're being a little bit more transparent. But I think both of them are on an incredible trajectory.
All right, well, that's all the news for this week. Come on. What do we have lined up for our valuation corner this week?
We're going to talk about Hadrian this week. So it's going to be more defense, more autonomous. This is an autonomous manufacturing platform just raised at an $8 billion valuation from a whole raft of excellent investors. So we'll talk more about that at the valuation corner.
You ever take it off any sweet jumps? You got like 3 feet of air that time. Can I try it really quick?
This week, we're going to be covering Hadrian.
Yes, indeed. We're going to be talking about another defense company in our ongoing series. We've covered a few companies in this category. I thought we'd do one more, only because they just recently raised and announced at a $8 billion valuation. So I want to talk you through this company and let me take your temperature along the way, Dave. Put on your 500 Startups hat and see if you were being pitched this company at the accelerator. What would you think? So they are a manufacturing platform that is designed to accelerate and reduce the cost of aerospace and defense production. So a lot of automation and manufacturing. It's an interesting category. It's a Series D, so kind of a late stage round. They just raised $1.37 billion. They've raised about $2.4 billion to date. Certainly a success in terms of fundraising. A couple of famous investors, well-known investors. Vail Equity Partners is the seems like the big one in the lead. A few others. They're fairly new to the game. They were founded, I think, in 2020. Revenues $3 million in 2023, between 30 and 50 million in 2025. As of the end of last year, hadn't really shown a lot of commercial traction. Estimated to be in the low hundreds of millions in 2026. Let's say maybe 200 million. If that's correct, we're talking about a 40 times revenue multiple. There's the financials. They've raised a lot of money, don't have a lot of commercial traction. Revenues are certainly growing at a rapid rate, but you haven't really broken through on the revenue side yet. I don't know if I'm impressing you yet or not, but
Well, it looks like those revenue projections look pretty amazing. I'm trying to understand how it's gone from maybe a 10x growth in the last couple of years, and now projected another 3x or better growth going forward.
well, they've signed a lot of contracts, which we can get into. They fair to say, I think to date, their revenue traction has been, the growth rate looks really good, but off of a low multiple. Let's talk about the founder. His name is Chris Power. He's the CEO. Before university, Chris was a musician. He says in his bio that the reason he got into, I know you always ask Dave, what got you to start this company? What's your motivation? Why do you want to do this? He said he wanted to build a tech enterprise when he saw Facebook went public in 2012, and he wanted to be just like Mark Zuckerberg. Again, I don't know how you rate those motivations or the resume so far, but it doesn't seem obvious, right? Like this is a multi-billion-dollar founder.
Well, sounds like he likes success and money, but I'm not sure whether that's tied to the success of his business. I don't know that he has a background in defense tech coming as a musician, but I'd be interested to hear more.
Well, he didn't up until 2020. He had done, as far as I could tell, nothing in his background would tell you this guy is going to be a major player on the stage as far as manufacturing, as far as building stuff, selling to the army. I just want to do a quick contrast. Remember when we did Reflection AI? That was Misha Lashkin and then Ionis Antonoglu. And I said, if you had to build a perfect AI CEO, you would give that person a computer science degree and make him go to Yale University or make him go to the University of Chicago, like one of the top universities in the world. You would make sure that this person got a chance to work with the best people in the world as far as artificial intelligence, right? You'd want this person to train in theoretical physics and join Google DeepMind as like a researcher, and then work his way up to Gemini, and then become like found a company in AI, and then get backed by YC, and it was backed by Mark Cuban. That's like Misha Lashkin. That's Reflection AI. This doesn't feel like Chris Power. He's coming across as a very different type of CEO with a different set of backgrounds and skills. But if I haven't sold you yet, let me keep going though. So we're back into here's what they do. Here's the investors that they have in the Series D, Vail and a few others. Now look at their Series C investors: T. Rowe, A16 Lux, and Founders Fund. At the Series B, there were lots of investors, but A16 Lux and Founders Fund doubled down, and 137 Ventures invested in Shrug. And then the very early seed round was Lux. A16 led the round, and Founders Fund was involved. So they've got actually an A-plus set of companies behind them, which actually makes me think, okay, maybe I'm missing something. Maybe Chris has something going on here. The problem they're trying to solve is that the U.S. defense manufacturing industry relies very heavily on a very fragmented and aging set of machine shops. And these guys are operating with a very different solution. If that's a problem, their solution is, first of all, the software brain. They call it Opus. Rather than operating like a typical job shop, Hadrian runs its factories using a proprietary software platform, and the software coordinates every step of the process. So automated coding, CAD/CAM programming, all the way through to robotic machining and the quality inspection, the material scheduling, all that stuff gets done in a highly robotic way. Hadrian also claims its automated plants can stand up new military production lines in months instead of the years that it takes to build munitions and equipment and materiel. In fact, they're saying that they're 10 times faster and more than 40% more efficient than these legacy suppliers. Maybe a little bit of another edge is they have a non-traditional workforce. So rather than hiring and only requiring, like people with decades of skilled machinist experience, like some of these other primes do, they're standing this up with frontline technicians that they train and that they're able to incorporate into their software stack very, very quickly. And so that's a little bit of an advantage that they may have. They're very focused at building right now, they're building mega factories to build Navy submarines. They're building these specialized components for things like the Columbia class and the Virginia class nuclear submarines. And then they're basically focused on munitions and aerospace. So we know, because we hear this from the war in Iran, we're kind of running out of weapons and running out of material. And these guys are able to supply a lot of this stuff in a very rapid way, which seems like they could be important right now. They're selling primarily to the major primes, so Lockheed Martin and Raytheon, but they also have a partnership with Anduril, and they're dual use. So they're selling into commercial aviation as well. And then in terms of their revenue numbers, they have just signed, I guess this is the catalyst for the round. They just signed a deal with the U.S. Navy for advanced shipbuilding in Alabama. And the contract looks like it is a $2.4 billion contract. I don't know over what time frame that delivers or when those revenues will recognize. But for a company doing 50 million with an M in revenue last year, I guess to sign a $2.4 billion contract with the Navy, maybe that justifies the $8 billion valuation. So I think that's a tremendous sign of confidence, along with the fact that their early investors were amazing and they can raise, a lot of money. Those were all good signs. I don't know that I'm totally sold on the team, the founder, the Australian musician who studied accounting, who just wants to be rich, but at the same time, obviously the fact that he can attract the capital from those great investors and sign these contracts is a big plus. And I think that tells you why the valuation is what it is. So I don't know if you're sold. It does feel like a really interesting company, and one that seems to be executing against a real problem. The Army definitely needs, munitions and material. They will obviously be spending on anything that works. And it feels like the technology works. And so he's got a factory automated way to do that in a very efficient way.
Well, I was reading a little bit about the founder, and it seems like he worked at another Australian company called Ento that was doing shift worker scheduling platforms, and they sold that software into factory and distribution centers. It sounds like that's where he got some exposure to how factories were trying to automate, and maybe he was more interested in trying to figure out how to do factory automation and selling people software, and perhaps that's why he, decided to jump into the business he's in now.
Would you buy? Would you pass? Or would you want to learn more?
I think I'd probably be interested in learning more. I mean, clearly he's got some chops in selling and was able to, grow the company from 3 million to potentially 30 million plus in revenue. I guess they've been able to lock down some big contracts. We'll see if they can deliver on the execution.
That's kind of where I landed too. I think I would like to learn more. I felt like my initial survey was, I don't get it. But the fact he has been doing this for about 6 years, and I did actually listen to him on YouTube. He's a very thoughtful, charismatic, very charming CEO. A bit of a non-traditional background for what he's doing. He seems like he's built a great team around him as well, and has raised some money from some serious investors. They're in Torrance, California, by the way, right in LA. So, a lot of manufacturing, a lot of talent down there.
Well, it seems like he comes more from the sales side than the engineering side, but I'm sure he's got some talented engineers that he's brought on board as well. We'll see how it goes. All right. Well, thanks for that valuation breakdown, Aman.
Super. Thank you, Dave. See you next time.